Hi, and welcome to the X22 Report Spotlight. Today's guest is Daniel Ameduri. Daniel, back in March of 2008, called for the Dow of 8,000, the collapse of Lehman Brothers, AIG, and Washington Mutual. During the mortgage crisis, he helped people buy puts and options on countrywide mortgages. These puts saw a gain of about 1,400%. He's the creator and owner of Vision Victory, Future Money Trends YouTube channels, and the website futuremoneytrends.com. And I am very happy to have Daniel on the X22 Report Spotlight. Daniel, welcome to the Spotlight.
Thanks very much for having me.
Hey, thanks for being here. Now, back in 2008, looks like you made some calls and they worked out beautifully. And you saw signals, you saw signs that were going on back during that period. Now, fast forward to today, in 2016, what do you see happening in the stock market, in retail, in banks, in real estate, etc.? Do you see signs that we're heading in the same direction? Do you see signs that things are improving? What do you see right now compared to what you saw back in 2008?
2008, it was almost like the Trump election. Nobody saw it coming except for a handful of us. And to fast forward to today, many are concerned about what's going on with the central banks, what's going on with the sovereign debt crisis in Europe, even Asia, the U.S. So more people are certainly aware, and I think that's because 2008 never left. They call it the Great Recession. I think it was a depression, and it's ongoing. There are some structural problems in the U.S. economy, especially with our demographics. And there have been many things that nobody could have predicted that have come about of the 2008 crisis as unintended consequences. One of being which is the 62 to 74-year-olds, that demographic is not retiring. They continue to work. And that one of the reasons is obviously what happened in 2008, the setbacks, the possible foreclosures, the debt they find themselves in today, or layoffs and job changes. So that is actually extending a little lifeline to some of these programs that probably would be in a crisis. So it's very interesting what's happening. And if you look at the growth of the U.S., there's really essentially no growth. But with the printing of money and the $10 trillion of debt we've added on to the national debt over the past 7.5 years, the central planners have been able to pretend and extend. So when it comes to the stock market specifically, I don't see a massive pullback in the stock market coming in the near term. Now, all these predictions are very difficult. Obviously, there's so many things at play here. But, if I do see the upside to the stock market as being limited. I think your upside here is, another 10 to 15%. Your downside is 25%. However, there's got to be a big asterisk on that analysis, because if we see price inflation start to pick up, which may indeed be happening, if we see price inflation pick up, because we are seeing base metals across the board and other commodities are now rallying big, and that will result in, whether it's construction or what you eat, the tools you use, the electronics you buy, that's going to show up in prices. So if we see price inflation rise dramatically over the coming years, that actually could be good for stocks in general, just because stocks are backed by businesses. And if you have a devaluation of the currency, certainly it's going to encourage more investors and savers to enter the stock market, even though they've been forced to it at gunpoint with the low interest rates for the past 10 years. They might actually want to do it if the dollar starts to lose value. Now, so far, we're seeing the dollar rise, we're seeing the stock market rise, and we're seeing gold going on a 2 to 3 month correction now from its bull market that begun earlier this year. But if you just looking out at the next year here and few months as 2008 compared to 2016, I think it's a much different scenario. I think the likelihood of a near-term crash is much lower than in 2008, but the problems are much larger. So when something does happen, whether that's in the treasury market or a new war, the next crisis will be far greater than 2008 by 10 times. It'll be something that'll change all of our lives.
Now, I just wanted to talk about the stock market right now. I mean, we're seeing it continually move up. I mean, ever since Trump was elected, and a lot of people are saying, well, the market's moving up because people feel better and things are improving. But we also saw other things occur during this period where we saw prior to the elections, the unemployment come down to 4.9%. Then it dropped even further to 4.6%, which we know is a manipulated number. We also saw GDP rise from 2.9% before the elections, move to 3.2% after the elections. Now, some people say, and I'm actually one of them, that they're trying to convince us that the economy is doing a lot better than it really is, because during Obama's last term here, he wants to go out with everyone looking at the economy saying, wow, 3.2% GDP. And it's just very interesting that it got to 3.2 because he didn't have, I think, one quarter that actually hit 3% or higher. And all of a sudden he did. We had unemployment drop, all the way down to 4.6%. And now the stock market going up like crazy. Now, when you look at the stock market, does this have anything to do with corporate earnings, sales, or anything like that? I mean, when you look at it, why do you think this is moving up so quickly like this all of a sudden?
Well, it doesn't have anything to do with corporate earnings, and it hasn't for a long time. When you consider all the pension funds and public programs backed by the government and fueled by government stimulus, the stock market is very important. The programs they've built, they're very dependent on the U.S. stock market specifically. And if it went down, you could see insolvency in many pension funds and many governments and local governments around the country. So you have a lot of forces pushing the stock market up and defending the stock market from declining. So it is an absolute gamble here, and it's about it's on the verge of being practically a state-run stock market, the way they price these stocks now. And, we have mysterious anonymous buyers coming from all over the world, which very well could be central banks. And we also know central banks are buying stocks on the open market. And if you think of the insanity of that, of being able to print fiat currency, whether you're the Swiss National Bank or Norwegian National Bank, and be able to purchase publicly traded companies, which is backed by perhaps a mining stock or a McDonald's or IBM. It's absolutely absurd, and that is the core reason why stocks are rising. Now, why is the general public still even interested in this, and large institutional investors? Where else do they have to go? And I think that's in their minds, right? We know that there are other places for them to go, but your bonds, the real yield on bonds is below even the CPI inflation, which we know is manipulated. It doesn't include energy. It swaps food prices out. So you have the real yield is below the price inflation, and they probably don't trust each other in general, because they know that most of the larger financial banks are completely dependent on central planners and the Federal Reserve. So they're buying stocks, and the stocks themselves, they're doing buybacks, which is reducing the share count and giving them, more fuel to bring the stock market to new highs. But no, the stock market is overvalued. However, it doesn't necessarily mean that it's going to have a correction. That's where, the market can totally screw you, and has screwed many people, including myself. Everybody's been bloodied up by all markets. I mean, it's the same thing on the flip side with gold. The fundamentals for gold have never been better, right? But gold has, over the past 6 years, seen quite a move down.
And since you mentioned gold, we know that Deutsche Bank, HSBC, Nova Scotia, they're all tied together of manipulating precious metals. Even though that's out there and they paid a fine and, it's in the news, we still see precious metals declining since the beginning of this year. What do you make of this? Why is precious metals being suppressed the way it is?
I think central planners have done an excellent, masterful job at suppressing precious metals and doing everything they can to remove them from individuals' savings. And, first by, of course, outright confiscation in the 30s, then outlawing it for, 30, 40 years. And now with just absolute suppression, both from the private banks and central banks, whether it's through their leasing programs or dumping billions of precious metals, gold ounces, into the COMEX, within a minute. It's just a very unsophisticated way to sell, that much gold or that much silver. And then we have the open manipulation that we've seen from Deutsche Bank and JP Morgan, now admitted in the court of law. But the market has no response, because most of the market participants that are managing the gold and silver price, they are fine. The system works out perfectly for them. They are perhaps short the precious metals right now, or they're working on behalf of the U.S. Treasury. And I always refer back to this statement that Paul Volcker said in I want to say it was in the 1980s. And they asked him what was one of his biggest regrets, and he openly said, we didn't manage the gold price. And I think that's what's happening here. When you've got negative interest rates for the first time in human history, and negative interest rates is a very, very nice way of saying default. Everybody said, will the central banks default? Will they default? And everybody said they'll never default because they'll just inflate their way out of the crisis. Guess what? They're defaulting. If you loan somebody money, if you loan them $10 and they give you $9 back, no one on earth would not call that a default, except in the last few years here, we've learned a new term, and it's called negative interest rates. That's insanity. There is no such thing as negative interest rates. It's default. So in order to keep the market participants not to reject these ideas and not to reject this type of form of stimulus, keeping the gold price down is very important, because the fact is, if gold was at $3,500 right now and silver was plus $100 per ounce and the dollar index was down around 50, we would have a real crisis, and they would not be able to do what is very unhealthy for the economy, and very deceiving to what's going on with the public. So for them to be able to do this, they need to keep gold and silver at bay, because the fact is, large institutional investors, other central planners, other governments, and very wealthy individuals and family offices, they do use the gold price as the canary in the coal mine. So by keeping gold down, it essentially makes the system itself look more stable.
So you mentioned interest rates and negative interest rates that were actually in a defaulting situation. And the Fed, going back to the beginning of this year, they said that, hey, we're going to be raising the interest rates maybe one time, two times, multiple times during this year. Here we are at the end of the year in December, and they haven't done it yet. Why is that? I mean, are they going to do it? And why didn't they do it?
I think it was an election year is why they didn't do it. And another reason is we know that the fundamentals just aren't there. Bill Gross talked about, you raise these things up just a point, and you're going to have trillions of dollars in losses here. And I think they will do it. I think we are going to see a Fed hike on Wednesday. It's going to be very small. We're talking about a quarter basis point. This is nothing. Nothing's going to change, and it doesn't even matter, to be perfectly honest with you, because interest rates are already rising. The market is already pushing bond yields higher, with or without the Fed. So here the Fed is just catching up to what's already happened. Mortgage rates are already rising. So the Fed is going to raise interest rates, but it's not in a significant increase. Really, it's just more window dressing. However, to that point, we have seen the Fed raise interest rates probably 3 times since the 1970s. Once in the early 70s, late 70s, and then in the 2000s. And all 3 times, I can't think of a better scenario for gold. It's funny, everybody's pricing in gold 900 right now because they're going to raise rates on Wednesday. But in the early 70s, gold doubled, more than doubled in the early 70s when they started raising rates. In the late 70s, went from probably 150 to about 850. And then, of course, in the 2000s when they started raising rates, we saw gold go from about $250 per ounce and ultimately entered into a bull market that took it to 1,000 at first, and then all the way to 1,900. So interest rates rising, especially the federal funds rate, is bullish for gold, in my opinion, because of what you've seen over the last, really the last 40 years.
Now, of course, when let's say they do raise interest rates and interest rates continually rise and gold heads the other way, everyone's going to be scratching their head going, okay, what's going on here? But if they do raise the interest rates, and we see the interest rates moving up, I mean, we see mortgage rates moving up, what effect is this going to have? Because already with mortgage applications in real estate, well, didn't we have this problem back in 2008 where rates started to increase and things started to break down? Will we see the same exact problem then if rates start to move up?
I think we'll definitely see a cutback in mortgage applications and housing transactions. Now, in 2008, we had a lot of subprime loans. We had prime borrowers doing all kinds of undocumented stated income. They call it stated, liar loans. There was, towards the end of the bubble, I can tell you in California, there was 1% loans, 1% teasers. There was 125% loan to value where you literally got paid to buy the home. None of that stuff is present right now, not in a big way. There is some creative, they call it exotic financing coming back into the market, but not like it was in 2008. So I think what you'd see more, rather than see a ton of foreclosures, you'd probably see a buyer's strike, because what's happened in areas like Austin, Texas, Southern California, Las Vegas, Phoenix, Florida, New York, is prices have gotten back to the 2008 level, but they're barely able to cling on to those prices, and it's driving the natives out of certain areas like Texas because it's becoming unaffordable. And if any small increase in the interest rate of mortgages would make it very difficult for new buyers. It's already difficult. They're already spread about as thin as they could go. So seeing mortgage rates go to 4.5%, 5%, even 6%. Would be the death of the housing market, which ultimately would lead to foreclosures. It would just take a little longer, because if you recall, the foreclosures of 2008 came from current homeowner defaults and people being unable to refinance. A buyer's strike, or I guess an unaffordable situation for buyers with higher interest rates, it would take a little longer to play out than 2008, only because it would come from homeowners who needed to sell their home but couldn't, or homeowners who needed to sell their home but need to lower the price because the housing market is taking another turn down. Which, by the way, prior to 2008, the real estate market in the U.S. was not a national real estate market. It would be more local markets. But because of the intervention from central planners, once again, the housing crisis, this next housing crisis, is for the most part tied together. And I think when you do see a pullback, you're going to see the pullback across the board. When
I'm looking at this and I see interest rates moving up, I see applications, declining, and we have I think a double problem here, because the housing prices are very high. And if rates start to move up, it throws a lot of people out of the housing market, which then you have all these homes on the market at high prices, nobody can afford them, and all of a sudden you see prices start to come down and down and down and down. And all those people who purchased during the height of this last market, and even the previous market, I mean, we're going to have a major problem, because they're not going to be able to move homes, and that's going to go into the construction area with lumber, electricians. I mean, isn't this going to be a cascading type of an effect?
Sure. Nothing sparks a depression like real estate. It was that way in the 30s, and it was that way in 2008. So certainly the whole idea of an infrastructure boom or even a base metals and commodities boom would be seeing the U.S. housing market have a downturn would be a huge headwind. But we'll see. My opinion is that even though we're going to see interest rates rise, we could quickly see them reverse. It's very easy to see how emergency measures could be put in place within the first year of President-elect Trump's first term in office. So, especially with Trump being a very active president, and as far as with a business and trying to actually change things, he could see a lot of pushback. And when that happens, you could see us go right back into crisis mode, which the Fed would lower interest rates at that point, regardless of who's president. We're actually writing a report, just to tease this real quick. If you go to futuremoneytrends.com, in about a week and a half, we're actually releasing a big real estate report on our forecasts, and it'll include several key markets as well.
You mentioned Trump, and he's promising a lot of things. He's out there, telling everyone that he's going to put America back on track, America's first. And with any politician, I know he's not a normal politician, but people say a lot of things until they're in office, and he's not in office yet. But we still have the underlying problems. They're still the same. We have a huge amount of debt, not just here in the United States, but globally. We still have the central bank, and we still have the threat to the petrodollar in the Middle East. So, in my view, I mean, maybe you see this differently, has anything really changed? I mean, in the economy, even though Trump is coming in, can he reverse all of this? Is it possible?
Yeah, I don't think it's possible. You'd have to swap out the entire Congress and Senate. And you'd also need a significant amount of high integrity mayors across the U.S. because, a lot of people don't realize, they think the federal government is, all powerful. It's not. And there are many, many stories about the regulations going on in local cities, the code enforcement, businesses trying to get permits in certain cities, and certain cities wanting to try to dictate what these businesses are going to do and regulate them and try to control them, micromanage them. So Trump's one guy. He's the president. He's going to be the president of the United States. It's certainly going to help that if he does follow through on his promises and his commitment to change. I think Trump, in my opinion, can be a force for good, certainly, because he's not tied down to any ideology. I don't think he's a Republican. I think he's more of a third-party candidate. And Trump will be very open-minded and will look for solutions. I just hope that the people who have good solutions, like people like a Ron Paul or Rand Paul, I hope they're able to reach out to him. I was talking to several people that at a conference a few weeks ago, and there's a lot of good ideas out there that can help fix things in this country. But I just don't know if the president-elect's going to get to talk to those people. But I kind of am a little optimistic that if he did, we might actually see some of those things happen. I tell you, if Jim Rickards was able to sit down with the president for 1 hour, I would be a wild-eyed optimist about this country. But I still don't see the people like Jim Rickards. I don't see Ron Paul or Rand Paul, going over to his office to meet with him. Today we saw Kanye West go over there. So, look, I do think Trump overall is going to be not bad. I guess I should put it that way. Because I don't think he's part of the oligarch. I don't think he is. He's like Clinton, where he's tied in with all the corporatism and the crony capitalism. But Trump, he's going to counter a lot of that stuff. But we have to remember this. What Trump is up against is over 100 years of the Federal Reserve and the world's largest corporations embedding themselves deep into our government and into all of the laws and regulations. That cannot be undone or corrected in 4 years. It is impossible. And when it comes to the debt, they may just throw this whole damn thing and have it blow up on Trump, which is very interesting, because that would be a one-party situation where you'd have a Republican Senate and Congress and a Republican president having a major economic crisis happen. That would be very interesting. I can imagine there are groups and forces that would like to see that happen, but we have to remember many of the Republicans, the vast majority of them, are part of that system. And I don't know if they're going to do anything to stop that, because that obviously it would affect them. It would affect Paul Ryan and his cronies as well. But as far as Trump, I think he's definitely gonna build border security. He's going to renegotiate trade deals, and I think he's gonna over deliver on several of his promises, especially when it comes to keeping manufacturing jobs. But I don't know if that's going to help. A lot more needs to be done, and he's got an uphill climb. I mean, I wish him well, because what he's up against, no man on earth has ever tried to go against. So I hope that he is alive for the full 4 years and is able to do what he does, and I wish him and his family safe.
Yeah, because we can see what the deep state, what they've been trying to do with the recount, with the Russian hacking. They're trying to do quite a bit before December 19th, before the Electoral College meets. And we can see right now they're trying to get the Electoral College maybe to invalidate the elections. And to me, it seems that they're doing whatever they possibly can to stop him from getting into the White House. That seems to be their plan right now. And I do agree with you that if he does get into the White House, that maybe a couple months in 2017, they might even bring down the economy just to say, see, his policies didn't work. He just destroyed the economy. And look where we are right now. But on the other hand, we have other problems out in Europe, like Deutsche Bank, the Italian banks, and those might blow up anyhow, because we can see they're in huge amount of trouble. Do you think the Italian banks might set off a chain reaction? Because, I mean, right now they're completely insolvent.
I do. I really do. I think you have Italian banks. You obviously have Deutsche Bank, and you have banks in France, and you even have U.S. institutions like our pension funds. That there are many things that could set off a crisis here, a global crisis. And so I would say my biggest fear between now and Inauguration Day isn't so much something happen with the economy, because I think they'll hold together for 5 weeks. It's really a war, and specifically a war with Russia, because they had, Hillary Clinton was, almost going out of her way to pick a fight with the Russians, and now it doesn't let up, and that's very concerning what's going on. So, I hope that this is not some sort of setup or some sort of plan to keep Trump from taking office, or to extend, Obama's presidency under emergency terms. Especially, if you're at war with Russia and you have a situation where the president-elect, a lot of the country thinks that he was elected because of Russia, I can totally see some sort of emergency measures. But I don't want to even go there, because that hasn't happened. So far it doesn't look like that's happening. And Trump is, I know a lot of loyal Trump supporters who are very, very disappointed that some of these deep Washington insiders are coming into his administration. But, if Trump is what I think he is, and that's an honest guy trying to genuinely do this with good intentions, I think it's very smart of him to do that, because you have to bring these insiders in as a hedge to protect you. You want to at least align yourself with them in some way, so that he does Oval Office and is able to make some meaningful changes. But as far as the Italian banks, I think there's a high risk there, and in other European countries as well. So Trump or any president, no matter what they do here, there are black swan events. I mean, a flock of black swan events that could happen over the next 4 years, which is one of the reasons why I think it's more important than ever to have physical gold and silver, and get your financial house in order. Now is not the time to make big risks. Now is the time to make sure your family and yourself and your friends are prepared to weather a storm, because a storm is coming. I don't know if the storm is going to come in 5 years or 10 years, but this entire debt crisis, this entire fiat currency crisis, it's going to reach a point where markets reject it and markets panic. And when that happens, you're going to see the whole system unravel. And that is, one of the things that everybody needs to prepare for. I don't think you need to live for it. You don't need to be, hiding in your house with a can of beans and saving in ammunition. but it's certainly something you need to be aware of, you need to prepare for, and you need to know that day is coming.
Daniel, we're moving into 2017 now. Do you have any predictions about the economy, investments, or anything like that coming up? Do you want to lay out what 2017, what you think it's going to look like?
I think 2017, because of it'll be President-elect Trump's first year in office. Historically, those are good years for the stock market. The U.S. is overdue for a recession. Even if you considered us not being in recession, it's overdue. So I do think we are going to see some signs and some unravelings, like you said, in the mortgage market that could have a high impact, negative impact on the U.S. economy in 2017. With that said, I would say one prediction that I feel very confident about is the gold price. A lot of people are feeling pretty upset, and they've had a gut-wrenching correction here. But if you look at a gold chart and you consider that the gold bottomed at 1,048, and today it's about 1,160. You look at the GDXJ, the junior mining companies, they have risen from about $19 on the GDXJ to 34. I think we're in a bull market in gold, and it is going to continue into 2017, 18, 19, probably for the next 2-3 years. We were at an unprecedented cyclical low in 2015, and I think that massive sharp rally we saw, it was a violent rally in the mining shares especially. That is something that will continue in 2017, probably after Inauguration Day.
Daniel, thank you very much for being on the X22 Report Spotlight. Once again, how can people see your work?
If you go to futuremoneytrends.com, you can subscribe free to our weekly Wealth Digest. We have a big announcement happening on January 8th, so please check us out and make sure you're subscribed. You'll get wealthy ideas, again, an awareness that we have a crisis coming, but we also want to still focus on protecting and building our wealth even in these times. And again, January 8th, if you're subscribed to futuremoneytrends.com, we have something we're going to reveal that's going to shock everybody.
All right. Thank you very much, Daniel. Thank you for being on the Spotlight.
Thank you.